Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Thank you for joining us. As bankers, you're often at the heart of business deals, whether it's approving an SBA 7A loan or guiding clients through a transaction. But there's one question that keeps popping up. Why does the value of a business change when the deal structure changes, even if the business itself hasn't? In this session, I'm going to walk you through how a company's capital structure, the mix of debt and equity, impacts its valuation. We'll cover why an asset purchase and a stock purchase can give you different numbers, and I'll show you how to explain this to your clients. Best of all, this isn't just my opinion. It's backed by Nobel Prize-winning financial theory. Let's dive in. First, let's clarify two key terms: enterprise value and equity value. Enterprise value is the total value of a business. Think of it as what the business is worth to everyone who's invested in it, shareholders and lenders. It's the big picture, independent of how the company is financed. Equity value, on the other hand, is what's left for the shareholders after you subtract any debt. If a company has no debt, enterprise value and equity value are the same. But when debt enters the picture, equity value shrinks because lenders get paid first. Here's the math. Equity value equals enterprise value minus debt. Simple but powerful. Now, how do we actually calculate these values? There are two main approaches you'll see in valuations. Free cash flow to the firm, or FCFF. This is the cash a business generates before paying interest to lenders. We use this to calculate enterprise value, and we discount it using the weighted average cost of capital. Weighted average cost of capital is the blended cost of debt and equity financing. Free cash flow to equity, or FCFE. This is the cash left after paying interest and debt obligations. We use this to calculate equity value directly, and we discount it using the cost of equity, which reflects the return shareholders demand. Here's a key point. In a company with no debt, these two cash flows are identical. But when debt comes into play, everything changes. Let's bring this to life with an example. Imagine a debt-free company generating $1 million in cash flow each year. The cost of equity, the return shareholders expect, is 20%. Now let's compare two scenarios, a stock purchase and an asset purchase. Scenario 1, stock purchase. In a stock deal, the buyer takes over the company as is, with no new debt. We use the free cash flow to equity, $1 million, and discount it by the cost of equity, 20%. Do the math and you get an equity value of about $5 million before the marketability discount. Since there's no debt, that's also the enterprise value. Straightforward. Scenario 2, asset purchase. Now suppose the buyer finances the deal with 80% debt. Debt is cheaper than equity because of tax-deductible interest, so the weighted average cost of capital is about 10%. We use free cash flow to the firm, still $1 million, and discount it by the lower weighted average cost of capital of 10%. That gives us an enterprise value of $10 million, again before the marketability discount. But the buyer borrowed $8 million, so the equity value is $10 million minus $8 million, or $2 million. Pause and think about that. The business hasn't changed, same cash flows, same operations. But the enterprise value jumps from $5 million to $10 million because of cheaper financing, while the equity value drops to $2 million because of the debt burden. That's capital structure at work. So why does this happen? It's not magic, it's science, backed by two economists named Franco Modigliani and Merton, who won a Nobel Prize for this in 1985. Their capital structure theorem says, in a perfect world with no taxes or risks, how you finance a company, debt or equity, doesn't affect its total value. But in the real world, debt can increase a company's value because interest payments reduce taxes. That's called a tax shield. However, there's a catch. Too much debt raises the risk of bankruptcy and other costs, which can drag the value back down. This balance is called the trade-off theory. Oh, and one more thing. When a company takes on debt, shareholders face more risk because they're last in line to get paid. So their cost of equity, the return they demand, goes up. That's another piece of Modigliani and Miller's wisdom. What does this look like after the deal closes? Let's stick with our asset purchase example. Post-transaction, the company's enterprise value is $10 million, thanks to the lower weighted average cost of capital from the debt-heavy structure. The equity value is $2 million since $8 million goes to debt holders. But here's where it gets real for you as bankers. The buyer's risk has gone up. They've got less skin in the game and more debt to service. For SBA loans, this is critical. You need to evaluate whether the business can handle that debt. Higher leverage might make the deal work, but it also makes it riskier for everyone involved. So, what should you take away from this? Capital structure matters. Debt can boost enterprise value by lowering the cost of capital, but it reduces equity value because shareholders take on more risk. The deal type drives the math. Asset purchases use cash flows to the firm and weighted average cost of capital. Stock purchases use cash flows to equity and the cost of equity. This isn't guesswork. You're standing on the shoulders of Nobel Prize-winning economists when you explain this to clients. And here's how you can break it down for your clients. Look, we're not pulling numbers out of thin air. We're using proven financial logic, stuff that's won Nobel Prizes. Adding debt can make a business worth more overall because of tax savings, but it also makes the deal riskier for you as the buyer. That's why the value changes when we switch from an asset deal to a stock deal. Before I wrap up, a quick shout out to the sources behind this. If you want to dig deeper, check out Financial Management by Brigham and Earhart, or the original papers by Modigliani and Miller. They're the gold standard. Thanks for joining us for this episode of the Valuation Desk. When you need clarity, confidence, and credibility, experience makes all the difference. At Highland Global, every appraisal is backed by decades of expertise and thousands of completed reports. We don't just crunch numbers. We provide insight, context, and defensible conclusions that lenders can count on. Whether it's a business acquisition or equipment appraisal, our seasoned approach helps ensure your deal moves forward with precision and trust. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.